Hey everybody, it's Nolan Smith again at Ocean Vale Mortgage and Finance, and today I want to talk to you about what goes into determining what kind of an interest rate you can get approved for. Interest rates are all over the place right now. There's a lot of factors that go into determining what kind of a rate you qualify for, which one you end up with. The rate market has been nuts, and it's no longer as easy as calling us or any mortgage professional and saying, what is a 5-year rate if I'm to get a 5-year fixed rate? What do I get? It's just impossible to answer that question anymore. The reason why is because of all the regulations around mortgage lending has forced a lot of lenders to compartmentalize money and lend certain money out for certain products under certain credit scores and down payments and all these things. So I want to tell you 3 things that will go into determining what kind of an interest rate that you're going to get. First thing is your credit score. You got to have a good Beacon score in order to get a good interest rate, and that's sort of, I guess, common knowledge. If you have a terrible credit score or a terrible Beacon score, you're going to kind of be dealing with alternative and private lenders. Alternative lenders, B lenders, they're around the 4 and 5% range right now, and private lenders are up to the 8 and 9% range right now. You want to see your Beacon score above 620 generally, and anything above 700, you're in the AAA zone. That's the Beacon score, so that's going to be the first indicator on what kind of rate you can get. The second thing that goes into determining what kind of a rate you can get is your amortization. Amortization is the length of time that it takes to pay your mortgage off. A lot of lenders premium their interest rates if you go above 25 years. So if you want a 30-year amortization with a lower payment, you're going to get a premium on your interest rate. And the third thing that goes into determining what kind of rate you get is how big of a down payment you have. So this seems odd that the less you have down, the better your rate is, but let me just explain how it works. If you only have 5% down versus 20% down, you're going to actually get a better interest rate. And the reason why is because if you have 5% down, your mortgage has to be default insured by CMHC. So they have to default insure your mortgage. Now, insurance, not to be confused with life insurance or disability insurance, this is mortgage default insurance. What it means is if you miss your payments, and the bank has to foreclose on your home, if they take a loss on your mortgage, the government's going to pay them for that loss. So that's a really low risk loan for a bank to write out or a mortgage lender to write out, knowing that their money's guaranteed. So they can offer the best, most competitive rates if you have a low down payment. Problem is it comes with a big insurance premium to CMHC. So you have to pay that 4%. If you're at 5% down, 4% on top of that net mortgage is what it's going to cost to get you your insurance premium. That's really expensive. You have 20% down or 25% down, 30% down, your rate's going to be a little bit higher because a lot of lenders won't default insure those. Some do anyways, and you can still get really low rates, but if it's not insurable and you can't get default insurance on it, you're going to get a higher rate as well then. So the bigger the down payment, the higher the rate. The lower down payment, the lower the rate. Very strange, but that's just the way it is. If you have any questions about rate pricing, there's a lot more that comes along with it. Again, I don't want to make these videos way too long and bore everybody, but if you have any questions about it, feel free to either comment on the video or give us a call or hit up our website and chat with us. Again, it's Nolan Smith at Ocean Vale Mortgage and Finance. Thanks for your time.